Okay, so Yutos, today we are going to be revising one key concept related to terms of trade and exchange rates. So, broadly speaking, today's session will link to two main points in the course outline. So, firstly, the relationship between the balance of payments and the exchange rate, and secondly, the effects of changes in the exchange rate on the economy, and specifically changes related to exports and imports, mining and manufacturing sectors, tourism, aggregate demand, and inflation. So, all these um, points can be found in the course outline for this course. So what will we be covering today? So we are going to have a look at the impact of the depreciation in the Australian dollar on the Australian economy between 2012 and 2015. So we've covered many of the key concepts related to this situation before. So things like the drivers of the Australian dollar, what occurred in the global and domestic economy between 2012 and 2015, which were related to commodity prices and so on. The key concepts or the key points that I want you to take away from the case, which is, as I mentioned, the depreciation of the Aussie dollar between 2012 and 2015, is how the Australian dollar depreciated due to the fall in the terms of trade. So the terms of trade is a concept, again, that we've covered before. Broadly speaking, you can see the equation at the bottom of the slide. So it is the index of export prices divided by the index of import prices times 100. So what happened between 2012 and 2015? So we know that commodity prices declined during that period as a result of slowing demand for those commodities from China. So commodities like iron ore, coal, so those were the two key commodities that were being imported by China from Australia, and the weaker demand from China led to a decline in those commodity prices. Why would that matter for Australia's currency, the Aussie dollar? Well, we also know that 75 or 65% of Australia's exports are primary commodities, and those include the commodities that I mentioned before, so iron ore and coal. So a decline in those commodity prices would flow onto the terms of trade, specifically the numerator of the terms of trade, because we export a lot of iron ore and coal. And a decline in the numerator of the terms of trade would lead to a fall in the terms of trade and thus a fall in the Australian dollar. So now we're going to think about or go through the impact of the depreciation of the Aussie dollar on the Australian economy. So it's important to think about the impact of any change in indicator or situation and what implications that might have for the economic health of both the economy as a whole as well as individual sectors, which we will do in the next few slides. So first of all, we've already spoken about how export prices would decline. So we know that iron ore and coal are key exports for Australia's economy, and the decline in commodity prices would thus result in a decline in export prices. And the decline in export prices would then result in a decline in the export price index, which again is the numerator of the terms of trade. So what impact would a decline in the export price have on the economy and on sectors of the Australian economy? First of all, a decline in export prices as a result of the depreciation of the Aussie dollar would make exports more competitive. We know that if the Aussie dollar weakens, the prices of exports decline, and when prices decline, these goods that are being sold are cheaper and thus more competitive. So as the impact column on the slide demonstrates, so exporters become more competitive. So what are some of these exporters? Some of the exporters would be commodity exporters. So those mining firms that export commodities. So they would be the key exporter in this regard. But we also have covered how export of education and and other services have become an increasingly important part of the Australian economy. So those exporters or those sectors that export those goods and services also become more competitive because prices have declined. A flow-on effect of the increase in competitiveness of those exporting sectors is a flow of resources into those sectors. So you know that during the mining boom, a lot of resources flowed into the mining sector because they became more profitable and were able to hire more workers. They were able to buy more equipment. They were able to utilize the resources of the Australian economy in order to create the output that is the export of commodities, and that is an example of structural change. So resources going out of other sectors into the mining sector, which has become more productive and competitive. So that's a summary of the change in the export price index and the impact such a change would have on the economy and on sectors of the economy. The next impact I wanted to cover related to the depreciation of the Aussie dollar is the increase in the import price index. So um, the depreciation of the Aussie dollar results in a decline in the purchasing power of the Australian dollar. So that means that imports become more expensive. Um, so we import a whole range of goods, and those include capital goods, electronics, consumer goods. All those become less competitive because they become more expensive. On the flip side, instead of importing goods from overseas, buying goods domestically becomes more attractive because of the change in prices. So if imports become more expensive, then you're more likely to buy goods domestically. And that makes import competing sectors more competitive. Finally, there's also an impact on inflation. So you know that goods and services, or the price of goods and services, result or impact the consumer price index, which is inflation. So an increase in the prices of imports of such goods and services purchased by households results in an increase in inflation and thus inflationary pressures in the economy. So what else does the depreciation in the Aussie dollar impact? So it also impacts the trade balance. So the impact on the trade balance can be broken up into two, components. So first, the immediate impact, which is often related to prices because prices move first, followed by a more volume-related impact as volumes change. So first of all, a depreciation in the Aussie dollar, as we know, results in a uh, decline in export prices and a related increase in import prices. So what that does is that reduces the amount of export receipts or the amount of money that Australian exporters receive in return for their exports. What that does is it deteriorates the trade balance. We know that the trade balance is export prices times export volumes minus import prices times import volumes. So if export prices decline, then the first component of the trade balance declines, which then flows on to the current account balance and thus widens the deficit. We can safely assume that happens because Australia is a price taker. So the Australian economy cannot set prices of its exports. It takes prices from the market, and as a result, we would suspect export prices to decline as the Aussie dollar depreciates. However, there's also the second round effect of a depreciation of the Aussie dollar, which we've mentioned briefly earlier. So a depreciation in the Aussie dollar makes exporters more competitive. So what that happens is it allows a change in volumes to flow through. So if prices of exports decline, we would expect volumes of exports to increase if the demand for such exports are elastic. So we can consider that, or we can assume that that's the case, that a demand for exports are elastic, and therefore a decline in the Aussie dollar and thus a decline in the prices of exports results in an increase in export volumes, which then narrows the current account deficit as a second round effect. So finally, what is the impact of a depreciation in the Aussie dollar on aggregate demand or the national economy? So we know that the second round effect is a narrowing of the current account deficit as a result of an increasing in the trade balance. The increase in the trade balance is strongly linked to an increase in net exports because the export component increases while the import component may fall or remain the same. So we know that if net exports increases, that is expansionary for the Australian economy. And when we think about the impact of an expansionary shock on the Australian economy, we need to think about those three key indicators that we want to consider whenever we think about situations like this. So we want to think about how economic growth changes, how unemployment changes, and how inflation changes. So an increase in net exports will result in higher economic growth. So we would expect firms to be able to sell more goods overseas and thus hire more workers, bringing in more profits and so on and so on. And through the multiplier effect, that would result in higher economic growth overall. Relatedly, unemployment would also decline because of that increase in employment through firms which are growing, either exporting firms or firms that service the export sector. And finally, inflation would increase because of, as we mentioned before, an increase in import prices, but also as a result of general economic growth driving price pressures upwards. So that was a quick summary of the impact of the Australian dollar depreciation on the Australian economy between 2012 and 2015. I hope that was helpful. If anything was unclear, feel free to play this video again and even ask questions to me when you get the chance. Thank you.